Hello, everybody. KT from Atocha Global Analytics. Elon says that things are far worse than they realize. All that today and more.
Atocha Global Analytics. Please like and subscribe.
Want to remind you that Atocha Global Analytics was created to provide insight and foresight into macroeconomics, real estate and finance trends, and the policies that shape them. And today we have a full gamut. We're going to do questionable truth of the day. Everything is fine, and policy matters because policies matter. And I'm going to start things off with the questionable truth of the day. So Elon said it all. He said that things are worse than they realize. He was talking, of course, in reference to the job numbers and the fact that they are not seeing in real time what's really happening, that there's some latency in their reporting. A reference, of course, the fact that they had a hotter than normal jobs number at 253,000 the end of last week, and they had an estimate of 180. Of course, the headline number doesn't happen to address the fact that there was a revision for the previous months. They overstated Q1 by about 165,000 or so. Just wanted to note some of the things that, even though he didn't include it in there, that are issues with the BLS job numbers. The job numbers, they do two types of surveys. They do a household survey and they do an establishment survey. The establishment survey is what they rely on. It is being consistently higher. I want to highlight the fact that the household survey, which has consistently been lower, in many cases significantly lower, but has been more accurate when you look at the adjustments that they've done in the past. Also, wanted to mention that there was a story that came out of the Philly Fed in December, and it was widely reported. You can find it everywhere online. CNBC, various news outlets covered this at length. The Philly Fed said that in Q1 of 2022, that BLS overstated job creation by more than 1 million. It was about a 1,050,000 or so overstated just in Q1 of 2022 alone. So the Philly Fed, in doing a backup audit of what they've seen, is calling out the BLS. And of course, the BLS wasn't happy to be called out about it. They don't want people refuting their numbers, especially by such a significant margin. But it sounds like somebody was cooking the books. There's something over there that is just not smelling right. So Elon, of course, highlighted the fact that that's a bit of a factor. So Elon, over the weekend, said this. He said that the Federal Reserve is committing a mistake by basing its rate indications on lagging indicators, which I wholeheartedly agree with. Instead of a beat, we would have had a huge miss if they had been looking at real-time numbers instead of lagging indicators. In response to the tweet, almost like there's latency in their data, so things are worse than they realize, which is absolutely true. Are the BLS numbers and the Fed's decisions based upon those accurate, or are they not? It's the questionable truth of the day. So before we get to everything is fine, I just wanted to read a quick story here. It's from investing.com. I guess it originally appeared elsewhere, and they picked up on it. It's called 4 Big Deal Reports, More Tremors Across Regional Banks. And of course, the regional banks have been a concern for a while. We've been noting it here. Other people, whether it's on YouTube or in business circles, have been highlighting this. This is a real problem. It's not just banks, by the way, but I just wanted to make note that these are the banks that are listed in this article that are of concern. Western Alliance denies rumors regarding a sale, while PacWest confirms. So PacWest is on the verge. It is a very troubled bank. Western Alliance is denying that there's discussions about a sale, whereas PacWest is saying there is going to be a sale. Either way, the stocks are getting hammered. So PacWest Bancorp is definitely a concern. Let's see here. First Horizon, of course, was going to be acquired or merged with TD Bank, and now that's been called off. So that one is definitely a concern. Arconic was to be acquired or to be acquired by Apollo Global. It's a relatively small bank. It's only 5.2 billion. As banks go, that's fairly small. But there's some other ones that weren't listed in this article I wanted to highlight. Zions Bank Corporation, Republic First Bank Corp, and Home Street, which is formerly known as Continental Savings Bank. All those are on the verge. So with that, of course, we're getting a lot out of the Treasury and out of the Federal Reserve that everything is fine. You know, the banking sector is sound, that the risks have dissipated. So here's a report from the Fed entitled Fed Reveals 722 Banks Reported Unrealized Losses Over 50% of Capital as Concerns Grow Over U.S. Banking Crisis. Now, of course, unrealized losses. I saw something very funny that I wanted to repeat. Someone commented and made a very funny joke. I'll repeat it here. Okay, so the joke was there's formerly three types of lies. There's lies, damn lies, and statistics. And the fourth form of lies now is unrealized losses via GAAP, GAAP, accounting standards. So anyway, take that for what it is. So the 722 banks, this is an article that just came out, but if you go down into the article, you find out that that was as of the end of the third quarter of last year. So we aren't talking about recent data. This is data that's over 6 months old, and it's, of course, interest rates have been going up ever since, so therefore it is likely a much higher number. But I just wanted to highlight a couple of things within the article. What we've been saying here and what is apparent to anybody who has any understanding of business and finance would recognize this. Rising interest rates are creating significant unrealized losses in investment securities and in some cases depressing tangible equity. As interest rates increase, banks with large market value losses could experience increased financial and risk management challenges. So that's obvious, of course, as rates rise, values fall. This was, again, end of third quarter 2022. It continues, it says, moreover, 31 of these banks report negative tangible equity levels, which means they are currently not able to borrow new money from Federal Home Loan banks and may lose the ability to sell loans to government-sponsored enterprises. So that's 31 troubled banks when, as of the end of the third quarter, that are to the point where they cannot operate in the banking system and they cannot get help from the Fed or interact with the GSEs, which, you know, Fannie or Freddie, to sell their loans. So they are essentially becoming paralyzed. You've heard of zombie companies? Well, it looks like we're developing some zombie banks, and there's far more of them than they have been reporting until recently. So again, everything is fine. Jerome Powell here said, despite multiple bank failures, he's insisted that the U.S. banking system is sound and resilient. And yet, those issues with Silicon Valley Bank, Signature Bank, First Republic Bank, those have all been resolved and all the depositors have been protected. Everything is fine, but of course the depositors need to be protected. So, last paragraph of the story is, multiple people have cautioned that the U.S. banking crisis is not over, including J.P. Morgan Chase CEO Jamie Dimon, who said last month there will be repercussions for years to come. Economist Peter Schiff also recently warned that the bank crisis is not over and a much worse financial crisis is incoming. Just saw that the CEO of Carroll which is a large multifamily REIT. It actually is the exact same size as a company I worked for, doing all 95% of their multifamily acquisitions during the 2013-2014 timeframe, when we were just coming out of the depths of the Great Recession. It was a very good time to do a lot of value add acquisition. So the entire portfolio of that company at the time was 33,000 units. So he just mentioned that the commercial real estate sector is in serious jeopardy. However, because his particular specialty is multifamily housing, he believed that would be strong due to the fact there's going to be strong demand for housing, specifically apartment-style housing, and things have continued to be strong there. Rents are strong. The occupancy levels are very high, record high, and he did not mention that there is an absolute avalanche of new units that will be impacting the market over the next 18 months, but he expects the demand to remain high, possibly because of single-family homes and people moving from some single-family homes to apartment homes in the foreseeable future, as housing is still going to be difficult to purchase and unaffordable and out of the reach of many of your lower-income buyers. Okay. And now for policy matters, because policies matter. Here we're covering a story that broadens the banking issue from just conventional banks to private banks, or what is often referred to as private equity, shadow banks, various other names. So here's a story. It says banking turmoil is paving the way for even bigger shadow banks, and we've got a slide we're going to cover. This came out of the New York Times, so it mentioned here that large banks, so raking in cash, are facing their own constraints saddled with loans written before interest rates started rising. Again, the interest rate issue. That means businesses large and small may soon need to look elsewhere for loans. And growing cohort of non-banks which don't take deposits, including giant investment firms like Apollo Global Management, Ares Management, and Blackstone, are chomping at the bit to step into the vacuum. For the last decade, these institutions and other like them have aggressively scooped up and extended loans, helping to grow the private credit industry sixfold since 2013 to $850 billion, according to financial data provider Preqin. Now, as other lenders slow down, the large investment firms see an opportunity. So here's where it begins to turn. It says, but the shift in loans from banks to non-banks comes with risk. Private credit has exploded partly because its providers are not subject to the same financial regulations put on banks after the financial crisis. What does it mean for America's loans to be moving to less regulated entities at the same time the country is facing a potential recession? It means that there are much more opportunities to imperil the financial system. That's what it means. So the rise of shadow banks. Institutions that make loans but aren't banks are known, much to their chagrin, as shadow banks. They include pension funds, money market funds, and asset managers. Because these shadow banks don't take deposits, they're not subject to the same regulations as banks, which allows them to take greater risks. So what happened as a result of the great financial crisis and the Great Recession, they put a lot more regulation on the banking industry, and by saddling the banking industry with that regulation, and at the same time creating a greater sense of immunity to these banks, because the FDIC and these other institutions are there to backstop them, there is no need for these banks to mitigate risk driven by market forces. So therefore, they are not operating in the same space. But these private equity guys, they typically charge more for loans, but at the same time, they're moving in a space where there's a lot less regulation, a lot less red tape, and so they have been expanding. When you deregulate, business often blossoms and it blooms. The insurance industry if you go back 40, 50 years, most insurance companies, like life insurance specifically, I happen to have had a life insurance policy my parents got me from Metropolitan Life. Well, at some point, Metropolitan Life became MetLife because they ceased being a mutual company, which meant the policy owners were the owners of the company, to a public company, and so they had stock that was traded openly on the exchange. They also became beholden to stockholders as well as policyholders, so they kind of have a split interest there. But at the same time, it allowed them to, because of the infusion of capital and working in a different space, it allowed them to grow much faster. So there's pros and cons to regulation, deregulation. So what has happened is, by regulating just banking and not regulating broad lending in general, they have constrained banks so that the type of lending has shifted away from banks. What would have normally gone through conventional channels will go through these more unconventional channels. So it says here, real estate is going to have to find a new home, and I think private credit firms are a pretty large place for that. Reduced credit availability for corporates, large and small, is a thing, and I think private credit is a big part of the solution. So even though the shadow banks have grown in scale, size and scale, it has not yet reached the level where anybody has taken action, but they are on regulators' radars. It says here, in Washington, shadow banks have been a point of focus, if not quite alarm, for years. As credit conditions tighten, they're getting an even closer look. The IMF has called for tougher regulatory oversight, and U.S. Treasury Secretary Janet Yellen said last month that she wanted to make it easier to designate non-banks as systemically important, which would enable regulators to tighten scrutiny. I think it would be a good thing for greater oversight. It's just that I'm not sure that the U.S. Treasury Department or any other government entity in this day and age is going to be able to do an effective job. Just to wrap up the story, it says here, I don't know that they pose the same kind of risks that the big wipeout of a lot of regional banks would pose. Ron Klain, former White House chief of staff, happened to mention about shadow banks in an interview in April. I think it's something that people will have to keep their eyes on. So they're waiting until they see an explosion, I guess, before they actually do something. So industry insiders argue that many private credit firms are just as friendly to borrowers and focused on repeat customers as banks are. These firms have no depositors, so only their own investors would be hurt by a bad bet. And that is noteworthy. A lot of the concerns around the commercial real estate sector isn't solely the individual loans themselves, but the commercial-backed mortgage-backed securities. The CMBS instruments that are out there are truly of systemic risk. They aren't as big as the mortgage-backed securities or the collateralized debt obligations that we saw during the great financial crisis that led to the Great Recession, but they are of a scale where they could easily do as much or more damage in this day and age because of the nature of the type of lending banks. And so remember, commercial, even though it may not be as big as the residential was last time, it really is a factor that the commercial side doesn't have the government backstops like Fannie and Freddie that we saw with the previous crisis. All right, so we've covered all the stories. We've ramped up production here, just so you know. We're going to be doing our segments on a daily basis every weekday, and we're going to be doing a lot more shorts, and we're going to be doing some informational videos. Just wanted to give you a heads up that our real estate program will be offered sometime this summer. We've already begun filming on that. We have... This is literally an expanded version of the primary course that I took at Harvard when I was getting my master's program. It's a fantastic course, one of the best in the country about real estate investment. And I will tell you that this will blow your minds. And included with the program, not only is the instruction and particular techniques and resources that you might not see or hear about in any other source, but you will have a complete underwriting show when you get done with the course, and you will be able to go out and you will be empowered to go out and confidently invest in real estate because the opportunities are coming and coming fast. Once the market really turns down and there are a lot of opportunities, you want to be prepared to take advantage of it. All right, one last thing is this week is going to be a little bit of an exciting week on the data front. Okay, so we of course have wholesale inventories that came out, or actually they're coming out as I'm shooting this video. So we will be covering that tomorrow. Tomorrow is a slow news day for economic data, but Wednesday is the big one. We've got CPI coming out. We've got the PPI and core PPI coming out on Thursday, and of course all the standard weekly releases that we'll be seeing. I want to ask you before we go, please like, subscribe, and ring that bell so you'll benefit from future releases of our videos. I thank you for your time. Catch you tomorrow.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.